This is Group 8, and we're presenting on Phillips Semiconductors. We have Armanat Yerhanyan, Garrett Glissmeyer, Mary Lopez, Ryan Whipple, and Clayton Gunn. At one point being the world's sixth largest semiconductor company, Phillips announced its intention to legally separate the Phillips Semiconductor division as an independent legal entity in December of 2005. Initially, Phillips planned on having an IPO for the division, but later decided on a leveraged buyout because of several advantages. Korn Van Zilge, a fund manager at S&S Asset Management, said, "I'm glad they're getting out of the semiconductor business. In the long run, that should increase the company's value." Meritz Heldring, an analyst at Kepler Equities, mentions, "Exiting chips will make Phillips less dependent on economic swings, and as a result become more predictable." The primary reason that Phillips was selling its semiconductor division was because of how much it caused its business earnings to rise and fall at different times in the year. At the time, however, private equity firms viewed semiconductor companies as cash cows, according to Paul McWilliams, a chip investor. This led to a couple of offers from two consortiums. In August 2006, Phillips agreed to sell to KKR, Bain Capital, Silver Lake Partners, Apex Partners, and Apple Invest Partners for 8.3 billion euros or 10.6 billion US dollars, making it one of the two largest leveraged buyouts of a technology company. In 2006, the sale of 80.1% stake was completed to the five private equity firms. After the sale, Phillips Semiconductors was renamed NPX Semiconductors, which stood for Next Experience, according to then CEO Frans van Houten.
The consortium consisted of five firms: KKR, Silver Lake Partners, Alpinvest Partners, Apex Partners, and Bain Capital. The leading firm in the consortium was KKR, which was established in 1976. KKR is known as the firms transacting in the first leveraged buyout in excess of $1 billion. KKR currently holds $8 billion in assets under management. Alpinvest Partners was established in 1999 by two Dutch-based pension funds. Alpinvest Partners' investment focus is in a secondary investor and equity mezzanine co-investor. Alpinvest no longer makes control investments in privately held companies, as they choose to always invest alongside select private company managers. Alpinvest currently holds $59.2 billion in assets under management. Bain Capital was established in 1984, and their investment focus is venture and expansion capital for private companies and growth capital for public companies in a wide range of industries. Bain currently holds $64 billion in assets under management. Apex Partners was established in 1969 and invests in five growth sectors. Apex primarily invests in tech and telecom, media, retail and consumer, healthcare, and financial business services. Apex Partners currently holds $40 billion in assets under management. Silver Lake Partners was established in 1999 and is primarily focused in investing in leading technology companies operating at scale. Silver Lake currently holds $16 billion in assets under management.
Some of NXP's largest competitors are Intel, Samsung, and Toshiba. Intel by far having the largest market share in the semiconductor manufacturing with about 13% market share. Samsung, though being the largest technology company in the world, only has about a fourth of its revenue coming from semiconductors, giving it a 19.3% market share. Toshiba coming in third with just a 4.3% market share. NXP, formerly known as Phillips Semiconductors, currently ranks 17th on the list of top semiconductor producers with $4.4 billion in revenue. It is headquartered in the Netherlands, which receives fairly favorable tax treatment for businesses. It has over 28,000 employees spread across 25 countries. is currently trying to grow its green chip and smart home automation departments. It currently holds about $898 million in cash, but it has a staggering, for its size, $6.6 billion in liabilities, giving it a negative $2.8 billion in net tangible assets. It is also interesting to note that it has 7 times debt to EBITDA, making it relatively twice as leveraged as its nearest competitor. Its initial public offering was August 6, 2010, at significantly less than the initial purchase price by the consortium of LBO firms. These firms were mainly trying to cut their losses as they purchased this firm at the near peak of the market before the 2008 financial crisis. In the middle of this year, the stock traded over twice the IPO price, but has now sunk back down to about $15 per share.
In 2006, fund participants each paid $4.37 billion in a $9.4 billion leveraged buyout. In 2010, NXP issued an initial public offering of $476 million. The proceeds went towards paying down the company's $4.5 billion in debt. Consortium players Bain Capital and KKR sold shares at 46% of the purchase price, making post-IPO ownership for KKR 28%, Bain Capital 24%, and Phillips Electronics 17%. Recently reported 2011 third quarter results display NXP's total debt at $2.28 billion, a decrease of $885 million since the second quarter. Post-third quarter ownership for KKR is 9.53%, Bain Capital 10.27%, and Phillips Electronics has sold all ownership in NXP, a dramatic change from post-2010 IPO. According to MarketWatch, fourth quarter projections indicate an 8 to 14% decrease in product revenue and decrease in gross profit of $412 billion, down from third quarter's $576 million gross profit. Measuring NXP's growth performance since 2010 as compared to the semiconductor industry and the S&P 500, NXP, shown in blue, has gone from below 10,000 to above 25,000 in less than 1 year. It is very extreme compared to the semiconductors industry, shown in orange, while its growth has been fairly consistent to the growth of the S&P 500.
Leveraged buyouts have continued to increase in the technology industry for several reasons. The semiconductor industry has matured over the past decade. It has become less cyclical, making it more reliable as a cash generator and creating for more consistent and predictable cash flows. It also has high margins and large cash reserves. From 1997 to 2006, there were 10 notable leveraged buyouts in the semiconductor industry. These LBOs ranged in value from $100 million to $17.6 billion. Some of the principal private equity groups involved were KKR, Bain Capital, Silver Lake Partners, and TPG. From the LBO, there are several key points to summarize the transaction. The 5 private equity groups, KKR, Silver Lake Partners, Bain Capital, Apex Partners, and AlpInvest Partners acquired 80.1% stake of Phillips Semiconductors. The LBO transaction was valued at $10.3 billion. Following the LBO, Phillips Semiconductors was renamed as NXP. Since the takeover, NXP has reported combined losses of $5.5 billion. As an exit strategy, the private equity firms sold NXP in an IPO in August 2010 for $476 million, largely reducing the company's debt. Shares were sold at a 46% discount compared to what they were bought for. Following IPO, Phillips Electronics had 17% ownership, and private equity firms had a combined ownership of 52%.